When should you buy? When should you sell? A very confusing dilemma, right? But what if there was a way to still get rich without having to time the markets whatsoever? Studies have proven that timing the markets can be profitable in the short term, but in the long term, it is a strategy poised to fail. Here's where dollar cost averaging, or in short DCA, comes in and saves the day. Dollar cost averaging basically means that you will invest equal amounts of money on an asset at regular time intervals, regardless of its market price. So let's say you bought $1,000 worth of Bitcoin at $30,000, but due to an economic downturn, you have lost over 50% of the money after Bitcoin hit $15,000 in just 5 days. Yikes. But what if you bought $200 worth of Bitcoin at $30,000 and then proceeded to keep investing $200 every 24 hours? At the end of the 5 days when Bitcoin was down 50%, your average buying price would be a lot lower than it would be if you dumped $1,000 all the way at $30,000. Thanks to dollar cost averaging, we did not lose 50% of the $1,000 we wish to invest. And since the markets do tend to go back up after an economic crash, you may be able to quickly start making money. Smart investors don't get rich by getting lucky on a few trades. They get rich by losing very little and compounding their profits every year. Another caveat of this strategy is that you will no longer have to worry about getting in at the best price using insane strategies that can lead to losses. Dollar cost averaging can reduce the overall impact of price volatility and lower the average cost per share. We all know that emotions are pesky and will almost always hinder our trading mindset. Even when your analyst shows you a winning buy-trade setup, your mind may not let you open the trade because of fear of losing. Thanks to DCA, you should no longer have to worry about whether the market has topped or is about to hit a bottom. As long as you're investing every week, month, quarter, or whatever interval you're using, you're likely to see the value of your investment increase over the long term. So how does investing regularly help to reduce volatility? In a scenario where the stock market or the crypto market is wildly jumping up and down due to some massive economic event, dollar cost averaging over time will help reduce the effect volatility has on your initial cost basis. However, if you fill your portfolio with inherently volatile assets, then the effect of volatility may become a little too much for this strategy to handle. Looking at historical data, the stock market has returned about 8% annually. As a result, time is always on your side, and dollar cost averaging can be an excellent way to get rich. DCA is a strategy you or your parents may already be familiar with, especially if you have a 401k savings plan at work or invest in an IRA. A 401k is a savings plan offered to employees that typically allocate a percentage of their income to investments they have chosen from the network the employee offers. The rules and principles of dollar cost averaging remain the same, except for a few differences. Your employer will allow you to have full control over how much and when you choose to invest. Plus, you have more than 5,000 different stocks to choose from, rather than a small number of mutual funds. With all things said, you should remember that dollar cost averaging does not guarantee that you will ever make money on a particular asset. In a declining market, DCA will certainly help to lower your average buying price, and in a rising market, it can significantly amplify your long-term gains. But as a smart investor, you should keep studying and learn to combine this strategy with deep research, as there's a good chance that dollar cost average will not only enhance your returns over the long term, but even wind up making you rich. To understand this strategy as well as possible, let's take a look at some alternative strategies to dollar cost averaging, each with its pros and cons. Although they can require a more hands-on approach, remember to choose a strategy that balances the risk with your expectations. Value averaging. First up is a strategy called value averaging. Unlike DCA, value averaging means that if you wanted to purchase shares in a company, you would purchase less when the price was high and more when the price was low. Yes, this strategy can reap high returns, but you are at great risk of not having enough money to continue buying shares when more substantial purchases are required in a down market. That's why dollar cost averaging is a much easier strategy, because it's passive and doesn't require larger investments during certain periods of time. Before you go ahead and try to DCA your way into your favorite asset, there are a few things you should know. First of all, you must have the discipline to stick to it. When the market starts failing, your mind may urge you to sell. That's why, despite the adage buy low, sell high, you may end up doing the opposite. Worst case scenario, you may stop buying in at lower prices and give up on the strategy altogether. Doing this would nullify the strategy's basic idea of buying more of an investment when the market falls. Plus, if you actually decide to follow this strategy, you can't fluctuate your position based on the current price of your investment in terms of increasing the amount you spend on the purchase of more shares when the price is lower and less when it is higher. Conversely, you may feel exuberant and want to invest more in a rising market. However, you will probably just end up paying a higher average price or buying at the top of the market. Oops! The second thing to remember is that dollar cost averaging does not mean you no longer have to do ample research when choosing the right asset to invest in. Buying a lump sum or value averaging or even dollar cost averaging into a bad investment is still a bad investment. A good idea is to use DCA as part of a passive investment strategy, meaning your goal is to invest in passively managed index funds that track an entire market such as the S&P 500. This reduces the amount of personal due diligence that's required from them compared to researching specific stocks or actively managed mutual funds. Oh, and another quick point to mention is to watch out for transaction costs, such as fees, commissions, and slippages. Your regular and frequent investments translate into lots of transactions, which might mean more costs eating into your returns. This is especially true for fixed transaction costs, charged by brokers who want $10 for every buy or sell position you open. Hence, many investors who use dollar cost averaging prefer to stick to low-cost, passively managed index funds, which charge a low percentage-based fee instead. Depending on the type of investor you are, keep in mind that thanks to DCA, you may end up with fewer shares than you think. The share price of an investment may rise over time, which means that you may be getting fewer and fewer new shares with each investment. For the DCA method, it is useful to choose an asset or an index fund that you expect to exist and increase in value in the future. This is why most hedge funds and retirement funds are heavily invested in the S&P 500, which has only continued to increase ever since it was founded. So that marks the end of today's video on dollar cost averaging. Hopefully you now fully understand all the rules involved in this strategy. The truth is, a beginner or a veteran can both heavily benefit from this strategy, considering you choose an asset that has historically proven to be a bullish asset. If you've learned anything from this video, please leave a thumbs up, and don't forget to subscribe and hit the bell icon for more awesome content.